Saving that first 25 lakhs takes years of discipline. Deciding where to deploy it takes even more. Traditional wisdom points toward real estate. It offers a physical roof, a sense of family stability, and an immediate boost in societal status. Modern financial circles push the stock market. Influencers promise a mathematically guaranteed path to wealth that requires zero maintenance and zero phone calls to tenants. Both of these absolute positions overlook the full picture. They focus on the potential gains while ignoring the massive, invisible costs that can erode your wealth over time. Real estate advocates rarely account for the high cost of debt, while stock market enthusiasts often ignore the brutal reality of how people actually behave when markets crash. To see how this plays out, meet Ram. He puts his 25 lakhs down on a 50 lakh flat and takes out a loan for the rest. He gets his keys, hosts a housewarming, and feels like he's finally arrived. His brother Sham takes the same 25 lakhs and drops it into a Nifty 50 index fund, committing to an additional 10,000 rupee monthly SIP. On day one, the social feedback is lopsided. Ram has a home and the respect of his peers. Sham has an app and a number on a screen that his friends find boring. Evaluating an investment based on these first-day feelings is a mistake. Compounding and debt take decades to show their true impact. We have to move past the initial celebrations and look at the actual numbers over a 15-year horizon to see who actually built more wealth. This chart breaks the real cost of Ram's flat. The 50 lakh sticker price is just the beginning. Up front, he pays 5 to 7% for stamp duty and registration, plus a 5% GST. His 50 lakh flat immediately costs nearly 56 lakhs. Then there is the 25 lakh loan. At an 8.5% interest rate over 20 years, Ram pays back 27 lakhs in pure interest. Notice the block sizes. He pays more in interest than the actual 25 lakhs he borrowed. On top of that, he faces society maintenance, property taxes, and the recurring cost of repainting and repairs every few years. If he tries to offset this with rent, he faces India's low rental yields, which average just 2 to 4%, barely enough to cover the interest on his loan. After 15 years, the property value might exceed 1 crore, but once you subtract the down payment, taxes, interest, and maintenance, Ram's net profit is diluted to somewhere between 65 and 80 lakhs. Real estate serves primarily as a utility asset. Using it strictly for investment means dragging down your wealth with high debt and constant upkeep. This chart shows Sham's path. By investing 25 lakhs plus a 10,000 monthly SIP at 12%, his 43 lakh investment grows to 1.85 crores over 15 years. Compounding does the work, earning a 1.42 crore net profit with zero maintenance. If the math is this much better, why aren't more people choosing stocks to get rich? Spreadsheet math assumes you act like a machine, but holding volatile assets comes with a heavy psychological cost, a behavioral tax. Look at these plunging red lines. In 2008, markets fell 50%. In 2020, they dropped 34% in a single month. When your net worth bleeds out on a screen, panic sets in. Most retail investors abandon their long-term plans and sell at the absolute bottom. Stocks also offer zero physical utility. You can't live in an index fund, and the dividends are often too small to pay your monthly bills. Finally, withdrawing that wealth triggers a 12.5% long-term capital gains tax, which takes another bite out of the final number. While index funds clearly win the mathematical race, they require an emotional discipline that many people find impossible to maintain. Trying to pick a single winner between real estate and stocks is the wrong approach. As this flowchart shows, the right asset depends on your life stage and goals. If your priority is family stability, and you'll stay in one city for a decade, the path to buying a home makes sense. Just ensure the monthly EMI stays below 35% of your income. However, if your goal is maximizing wealth with zero maintenance over the next 15 years, choose the index fund route. On this path, you must be certain you can watch your net worth drop 30% without panicking and selling everything. The most successful investors use a strategy called sequencing. Sequencing starts by building a compounding base in the stock market early on. You use time to let your capital grow while you are flexible with your living situation. You then transition into real estate only when you truly need the utility of a home, and can afford a significant down payment from your matured investments. Financial maturity requires layering utility-driven property with high-growth stocks at the specific life stages where you actually need them.